Welcome back. The S&P TSX Composite is down about 10% so far this year. And of course, U.S. equity markets are in deeper negative territory. It's been a tough year for stock market investors. Let's bring in Rob Tetrault. He's Senior Portfolio Manager at Canaccord Genuity. He's joining us from Winnipeg. Rob, great to see you again. Thanks for joining the program. When we asked you what you might like to talk about in today's appearance on the channel, you said you wanted to take a critical look at the 60-40 model portfolio that for many years has been thought of as at least one of the hypothetical models that long-term investors should be following. That's 60% equities, 40% fixed income.
Well, first off, I'd like to talk about the Blue Jays for 10 minutes if we could, but I don't think that's my spot here to do. Bullpen's doing real good. I like the bats. Bo Bichette heating up. I'd like to see that. But yes, these portfolios that we've been touting as perpetual portfolios, that there's no problem, regardless what happens with interest rates, you're going to be okay. Don't shed it. Just have 40% fixed income in your portfolio, 60% stocks. You will be fine forever. I've heard this my entire career. I studied it when I did my Canadian Securities course and my CIM and all these courses. And I've been pounding the table on this show and on your network for a while now, saying people are going to get hurt bad because individuals don't know and appreciate the fact that they have 40% of their portfolio that's going to get hurt in a rising rate interest environment. And not only that, but they're not really getting the income they think they're getting it, and they're not really getting the lower volatility, and they're not getting the correlation break that they would normally expect from stocks. So what have we seen in the last year? It's been a disaster. The largest funds in Canada, pick any financial institution, the largest banks or the largest mutual fund companies, the largest fund, like, the RBC balance or whatever it's called or whatever, they're all down double digits, 10, 12, 13, 14%. And Canadians don't really appreciate the risk that they're taking with those positions. So yes, I'm a big believer that model needs to change.
Is the problem the heavy fixed income component, the 40% part? Because another thing we've heard over the past many years really is that as people live longer, they need more elevated equity exposure, and they need maybe to hang on to that elevated equity exposure longer. So is for instance 70-30 or 80-20, are they better portfolio models in your mind?
Great question, Paul. I think it's two pieces to that. So the first part is correct, that we can't just allocate 40% of our assets to an asset class that's likely going to drop in value, and after fees and taxes, you're left with nothing. Why would anyone want to own that? If I told you you could own 40% of your assets generating zero and paying tax on that, would you own that? No, you wouldn't own that. Nobody would. So that's one piece of it, just the overall allocation to fixed income in a rising rate interest environment with ultra low, all-time low interest rates. But two, the other piece also is, you're right. Back when we were studying this in the 70s and 60s, life expectancy wasn't what it is today. So we weren't seeing financial planning going to, the Financial Planning Institute is now recommending financial planning till you're 92 or 93. While that doesn't necessarily, like when you're 65 and you're retiring, you still have like a 30-year investment horizon. So you can withstand 5 or 6 or 7 market cycles. So I'm not necessarily saying, to be clear, Paul, that everyone should own equities. That's not what I'm saying. All I'm saying is think of why you own fixed income. If you own fixed income because you want income, there's other ways to do it. If you own it because you want less volatility, there's other ways to do it. And if you own it because you want a different correlation to stocks, there's other ways to do it. And I'm a big believer in alternative assets. I've said it before, and maybe looking at different kind of dividend payers or other ways to do it than just jamming 40% of your portfolio in XBB, and then you're down like 13% year to date in 2022.
So let's talk more about those alternative assets. You say that your clients have done much better than the hypothetical 60-40 investor because you've brought alternative assets into their portfolios.
Yeah, and I've said this before, so I'm not kind of just talking about this now, but here's some easy ones for you. Private real estate, private infrastructure, farmland, even like private equity, music royalties, and even certain private debt offerings make a lot of sense for individuals. So those are a whole bunch of different asset classes. You could look at long-term like art, and you could look at collectibles like hockey cards and stuff like that. And those are all completely uncorrelated to the stock market. So they generate income. They're agnostic to what's happening in the world. In an inflationary environment, they're going to outperform. Why? Because there's less real assets. Therefore, if you own farmland and more people are eating and they're making less and less farmland and inflation happens, you end up getting a bump on the value of your farmland, as a specific example. But this is stuff that my clients own. And I'm not the greatest smartest, I'm not the genius ever, but I mean, I know that what we can do is if we can look at an asset class that's going to generate returns regardless of what happens in the market, that basket of alts for us this year, it's up double digits. So when the market's getting puked on and the bond market is getting decimated, it's good to have a chunk of your portfolio in those.
You really think that that ordinary investors of average wealth, in other words, people who are not high net worth individuals, should have part of their life savings, their portfolios, in things like hockey cards and art?
Well, I was using that as an example, but you raise a good question. Is this for everyone? My view on this is that if you can provide institutional style mandates of pension style approach to investing, like the alts that I mentioned there, that's a phenomenal way to, if you can bring it to the retail investor in a way that they're not burdened with undue risk and they're not saddled with the due diligence and the responsibility to follow up and all that. In other words, do it through a portfolio manager, a guy like myself, for example, then you're phenomenally reducing your risk, and you don't have to worry about the process, which is buying these things and not knowing what you're doing. If you actually do it through an institution that knows what they're doing, absolutely, Paul, retail Canadians should own this. Absolutely, unequivocally, because they're going to get better risk-adjusted returns. And that's what matters for Canadians, right?
Okay, let's finish with where you think the broader markets are going. Both the S&P 500 and the TSX Composite here in Canada have turned south. Will they retest their lows that they reached in June in the US and July here in Canada?
So Canaccord is calling for a little bit of a fall, so kind of a potential retesting or a little bit of a lower point here, September, October. We all know September is the worst month. October has seen the biggest crashes ever. But I do think that once we kind of get past this bump and this volatility, you're going to want to own equities, because there's a lot of technical indicators that show that 12, 24 months out from here, you're very happy to own securities. So you definitely want to own stocks. If you're sitting on cash, make a plan to put that money to work now, whether it's lagging it in over 3 weeks, 4 weeks, 6 weeks, 8 weeks, something like that. You should be buying equities at anytime the market corrects 20, 25%, you want to be putting that money to work. So I would strongly advise, if you're sitting on cash, to do so. And if you're not, expect volatility short term here, a little bit, and then expect to see markets come back.